Technical analysis trading is the practice of studying price charts, market trends, volume, and recurring patterns to predict future price movements based on the belief that all available information is already reflected in the price. One of the greatest practitioners of this approach was Jesse Livermore, a legendary trader who amassed a fortune by reading market behavior and famously profited from the 1929 stock market crash. Rather than relying on news, opinions, or economic forecasts, Livermore focused on price action, identifying pivotal points, breakouts, reversals, and chart patterns that signaled shifts in supply and demand. He mastered the art of recognizing trends, reading price and volume activity, entering major moves early. A key element of his strategy was pyramiding into winning positions, starting small and adding only as trades moved in his favor, while strictly cutting losses and never averaging down on losers. Beyond charts, Livermore believed market psychology was the true driving force behind price movements, understanding that fear, greed, hope, and panic create recurring opportunities for disciplined traders. He emphasized emotional control, patience, and strict risk management, teaching that preserving capital, trading with the trend, and waiting for the market to confirm an idea were essential principles for long-term success. Technical analysis trading is a market approach that seeks to profit by interpreting the language of price itself. Instead of analyzing a company's products, management, or financial statements, technical traders study charts, trends, volume, support and resistance levels, and recurring patterns to identify high-probability opportunities. The philosophy is simple. Markets are driven by human behavior, and because fear, greed, optimism, and panic repeat throughout history, price patterns tend to repeat as well. No trader embodied this philosophy better than Jesse Livermore, whose legendary career was built on understanding crowd psychology and recognizing when a stock or market was entering a major trend. Livermore believed that the biggest money was not made from constant buying and selling, but from patiently waiting for the right setup, entering when price confirmed his thesis, and then sitting tight while the trend unfolded. He focused on pivotal points where supply and demand shifted dramatically, using price and volume as his primary tools to detect institutional accumulation or distribution. His trading principles remain influential today. Trade in harmony with the primary trend, cut losses immediately when proven wrong, add only to profitable positions, never let hope replace discipline, and treat risk management as more important than profit potential. For Livermore, charts were not merely lines on a screen. They were a real-time reflection of collective human psychology, and learning to read them correctly provided a powerful edge in navigating financial markets.